Okay, hello everyone. My name is Steve Gatti. I'm a partner with the global law firm Clifford Chance, and I will be moderating a panel today called Supervised Disruption, U.S. Regulators Grapple with Crypto Assets, where we will explore how U.S. financial regulators and governmental authorities, including the SEC and U.S. banking regulators, are addressing the disruption of fintech in the financial services industry and how regulators are addressing those changes. We have a terrific panel today. I'm joined by Veronica McGregor, Chen, and Brian Farber. Veronica is Chief Legal Officer of the digital asset trading platform ShapeShift and leads the company's global legal strategy, advising on all legal matters with a focus on regulatory affairs, as well as guiding ShapeShift to achieve its compliance and business objectives. Prior to joining ShapeShift, she was a partner at Goodwin Procter and Hogan Lovells, where she had counseled companies on fintech matters. Pei heads America's business development team at Digital Asset, the creator of the DAML smart contract language. And previously, she was a director of strategic sales at Consensus with a focus on capital markets and payments. Prior to starting her career in blockchain, she spent nearly a decade at Goldman Sachs with their fixed income sales and trading division in the United States and Europe. We're also joined by Brian Farber, who's general counsel of Securitize, which delivers global solutions for creating compliant security tokens and is an SEC registered transfer agent. Prior to joining Securitize, Brian was in-house with Consensus and a corporate associate at Sullivan and Cromwell. So, fintech. Originally, crypto assets were the preserve of idealists and crypto anarchists and revolutionaries, but digital assets are attracting increasing attention and participation by the institutional investor marketplace. Although in some ways in tension with the early anti-establishment vision of crypto, Wall Street's entry into the space could be the bridge to Main Street that some argue crypto and blockchain needs to cross to reach their full potential. So I'm going to start with Brian. Brian, what trends are you seeing in the securities markets with respect to institutional and regulatory acceptance that prove that digital assets, specifically digital asset securities, are here to stay, and also cryptocurrencies as an institutional investor asset class?
Yeah, so I'm going to start, I think, focusing predominantly on the securities side, and maybe it's helpful for me to just paint a bit of a picture of how we got to where we are today. So the security token space was really born out of the ICO craze in 2017 and 2018. The original security tokens, you could look at Spice VC and Blockchain Capital, were issued compliantly in reaction to the sort of madness of ICOs, when people were looking at that and saying these are mostly unregistered securities here in the US. So those issuers saw the benefits of using blockchain, specifically smart contract technology, to automate compliance. They also acknowledged proactively that their tokens were representative of securities and not utility tokens. They embraced it. And this begot a flurry of privately placed security tokens. So they were issued here in the US through Reg D offerings or overseas through Reg S offerings, and then placed on chain. I would say probably right now, 95 to 99%, almost all of the security tokens that are outstanding were done in this manner. Securitize has acted as a tech provider and transfer agent for a number of these here in the US. Starting last year, we started to see a little bit of activity outside of the private markets. So you had two different Reg A plus qualifications for block stack and props. A little bit different than the traditional security token in the sense that they both kind of argued that these weren't necessarily securities, but they also acknowledged that the only way for them to reach retail investors on a broad scale was to go through some sort of Reg A plus qualification, short of doing, an S1 or an F1. So that was really interesting. It was a little bit cost prohibitive, I would say, which hopefully will change in the future. I think Blockstack spent over $1 million just on legal fees just to get qualified, which I guess will tend to happen when you're the first mover in the space, just because there obviously was a lot of back and forth with the SEC, discussion on how blockchain works, how tokens work, all of that. Recently, actually, in the last couple of weeks, we saw a registration statement of Form F1 go effective with the SEC for INX. They are a proposed offshore exchange of security tokens and cryptocurrencies. So that's interesting. I mean, maybe we're starting to see some offerings go through regulators rather than just being privately placed here in the United States. Perhaps one day we'll get a registration statement on Form S1 for a domestic issuer, but we'll see. But that's where we are right now on the the offering and disclosure side. On the non-offering side, you have a number of registered and regulated entities with FINRA and the SEC here in the US. You have registered transfer agents. There are a number of them, including Securitize, that are now operating in the blockchain space and using blockchain and tokenization as part of their sort of host of services that they offer issuers and investors. And you also have a number of broker dealers and ATSs here in the US that are beginning to trade tokenized securities. I think what we've seen is that it's really, really important for the regulators that there be gatekeepers involved in this industry as the regulators are starting to learn more and more about how the technology works. They want to be able to have people that they can trust involved in the industry. So we've seen a big push for people to actually get registered as transfer agents or broker dealers with FINRA or ATSs or a number of other registrations. But there's still a lot of work to do on the regulatory side, and I'm sure we'll talk about that today. But the infrastructure is definitely coming into place. On the institutional non-regulatory side, we've seen immense interest from banks and other large institutions. There's been a number of RFPs that have gone out to a lot of players in the space over the last year. It slowed down during the throes of COVID, but it's starting to pick up again. Large banks, particularly here in the US, are very savvy on this technology. They're very interested as an infrastructure play to save costs in the back office. They do think that this is the long term, I would say, of the capital markets, but it's definitely going to take some time. We are still very early days, in the development here, but that's the synopsis of where we are in the regulatory and institutional side, at least on the securities front.
Thanks, Brian. And so Veronica, taking it and looking at it from the standpoint of cryptocurrencies and non-securities digital assets, obviously there's been really an explosion of exchanges and activity in that area. But how do you see, in terms of the acceptance of those of cryptocurrencies and the development of those markets, where things are?
So in terms of securities, any exchange will, and ShapeShift does, have a digital asset review, token review, whatever you want to call it, process. And we expressly don't list things that our process has determined and our analysis has determined to be security, because we don't possess and do not intend to seek the requisite licenses for, broker dealer licenses or any other kind of licenses that we would need if we were to list on our platform anything that would be deemed a security. So I'm not sure I have too much to contribute on that level, because we expressly avoid anything that would be considered a security by design, because we don't want to have the same licenses that other people have.
But what about Veronica? Maybe for a second, but just in terms of regulation associated with cryptocurrencies, not securities.
Oh, regulation. Oh, well, I have a lot to say about that. So regulation in cryptocurrencies globally is something we have to keep track of. And what's very frustrating, particularly in the US, is that we have a number of regulators that have sort of either claimed the cryptocurrency industry as their jurisdiction, or they've at least sort of dipped their toe in the water as to like how we're going to characterize a cryptocurrency. Like, you know, the IRS says it's property, the CFTC says it's a commodity, and the SEC may say it's a security, depending. But you know, FinCEN says it's a currency. So and we have to deal with all of these regulators on some level, which makes it very difficult to figure out, you know, a cohesive compliance policy. We sort of almost have too many masters, right? In the EU, things are a little smoother because they tend to they tend to take a more cohesive approach even across countries, right? They'll do directives, and each country gets to implement it the way they want. But generally speaking, they try to make it so that, you know, all AML across EU, you can do one, you know, we'll have one sort of program that will work for all of that. So in the US, I would like it if we had just sort of one regulator would be great. The OCC, as you know, recently is you know, they have a FinTech charter, and they're weighing in on cryptocurrencies, which is no particular surprise since the new acting comptroller of the currency is Brian Brooks, who used to be the chief legal officer at Coinbase, and so he has a clear understanding of cryptocurrencies and what they, you know, in the potential for them. So I'm hoping that not just with Brian, but other regulators will kind of see the potential, the upside, rather than just the pitfalls of crypto.
Thanks, Veronica. So, Pei, anything to add to that from the standpoint from digital assets perspective of these regulatory developments, and in particular, you know, with respect to smart contracts in terms of U.S. regulatory developments?
Yeah, I agree overall with Brian and Veronica in terms of that. We're seeing a very exciting trend where the regulatory communities are coming in, getting educated and sending more clarification around rules and definitions. This is all great, but I think we're also seeing the investor side and tech side moving in pretty fast. So this is something obviously digital assets looking at very closely in providing the right tech and infrastructure for any type of digitization or tokenization of real world assets. There's some solutions out there, but they might be very expensive. They might only solve part of the puzzle or part of the money Legos. And we still have a lot of work needs to be done on that front. But I think from a data point of view, we're seeing a tremendous shift in interest from the institutional and the retail investor community. So give you some examples. Fidelity published a report in June that shows that 80% of investors found something appealing about digital asset. That can be cryptocurrencies, that can be security tokens, because it can provide diversification, but also because it gives them the exposure to an innovative technology and the potential upside that comes with it. And also, you probably read about it, Grayscale, which is the largest crypto fund to date. They raised nearly $1 billion just in the second quarter of 2020. So with the regulations becoming more clear, FinCEN, for instance, defining stablecoins as money transmitters, that clears some usability concerns. But I think also we want to, you know, from our point of view, we wanted to make sure to be there and facilitate from a tech and infrastructure point of view, and give that infrastructure and the platforms to issue those digital assets, not just from creating those assets, but also to bring that all the way through the settling, clearing, custody, and all the communications between all the multiple parties that would follow in a typical asset servicing world. It's very similar to what we are seeing with the traditional finance, but with a little bit of blockchain spin and a little bit of decentralized twist.
Thank you, Pei. One of the areas you mentioned there, and that kind of cuts across broad scale acceptance of digital assets by the institutional community, is the issue of custody, and how regulators are grappling with the issue of custody, and how institutional participants, what their demands are from a custody perspective. On one hand, you have the development of new custody options, but on the other, there are advocates of decentralization with respect to custody through self-custody solutions. Veronica, what considerations should investors take into account in deciding whether to self-custody or hire a custody provider? And is the landscape shifting around custody? And what are the regulators saying about custody? Packed a lot in there for you.
Right. So, so ShapeShift is a non-custodial platform. It's not really an exchange. It's kind of an exchange, but it's not an exchange in the traditional sense. So we try not to use that term. That means that anyone who wants to trade assets on our platform has to either have, they control their own keys, right? So they either have a hardware wallet or a software wallet. We also have our own software wallet and hardware wallet. And you know, the phrase is not your keys, not your crypto, right? So but the non-custodial solution, you know, can be a friction point for some folks. And that's, you're talking about investors, and if you're talking about institutional investors, they're talking about giant amounts of cryptocurrency versus a consumer. We are a consumer-facing platform, so I can speak from that point of view. There have been hacks. So if someone is custodying your crypto and they get hacked, then you lose your crypto, right? So Mt. Gox is the biggest example of that, or the earliest example of that, but there's been lots and lots in between there of major and minor hacks where people lose their crypto. And because there's no FDIC, there's no sort of insurance for crypto, if it's lost, it's lost. And you can try and sue the exchange, I guess, to get it back. But we certainly have received a lot of third-party subpoenas in the wakes of other hacks at other exchanges where we are trying to use Chainalysis or Elliptic, whatever, one of the investigatory tools for blockchain technology, where we can try and trace where the crypto went when it was hacked out of something. And so I guess I'm going to have to say I believe that non-custodial is best, where you self-custody, I should say, because, for example, we recently and this isn't like the best thing in the world, but it's been in the news, so I should mention it. We had an employee who stole from us, but he stole from us. He didn't steal from our users, and so as a result, because our users, we don't control our users' assets, so we got the money back. It was a terrible thing to go through. On the other hand, it really proved self-custody is the safest way to do this. And so that is definitely the message that I have come to sort of agree with. Like, well, if there's no insurance mechanism like with a bank account for a depository account at a bank like the FDIC, then then self-custody is definitely the way I would suggest people go.
Okay, thank you, Veronica. So Brian, shifting over to securities tokens, I guess we could say to date, all the SEC has permitted is, in essence, a form of self-custody, at least from a blockchain perspective, of a securities token. But the issue of custody, or said in SEC parlance, customer protection with respect to digital assets, has been a barrier to the widespread use of cryptographic and digital ledger technology, distributed ledger technology in the securities markets. Can you explain the SEC's concerns, and are there potential avenues to unlocking the market for digital asset securities?
Yeah, so in the summer of 2019, a little over a year ago, the SEC and FINRA put out joint guidance on custody of digital assets and digital asset securities for broker dealers. Now, this is very important in the security space because a lot of people, most people, hold their investments through brokers. So if you want institutional involvement on the security side, there needs to be a path forward for brokers or broker dealers to be involved so that you can get more retail money into the space and more institutional money into the space as well. The guidance from the SEC effectively said, Steve, as you previewed, which is that, look, right now, self-custody is kind of the way forward. And if you're a broker dealer, we're not really sure how you can safely custody security tokens. And this goes back to the customer protection rule, which effectively says, look, if a broker dealer fails or it goes bust, there needs to be protections in place so that the people who hold their assets or their securities with that broker dealer don't lose that, right? So there needs to be some protections in place. The SEC and FINRA were not really sure how a broker dealer could safeguard private keys in the context of security tokens. They made statements like, well, how do we really know that, you're the only person with access to those private keys? Now, I think people involved in the industry have different views on this. And I know that we and others are working very closely with regulators, or trying to work very closely with regulators to push this forward. It is the most important issue in the space right now from a regulatory perspective on how to grow this industry. As Veronica rightly pointed out, on the crypto side, not your keys, not your coins. On the security side, where people tend to be, less, I guess, crypto savvy, self-custody is a little bit of a tougher sell. I think sometimes with certain wallets, blockchain is hard. So it's very difficult, for example, for my mother to self-custody. So, broker dealers are important for that. So as for the path forward, I know that the SEC is actively thinking about this, and they're working very hard to come to a point where they feel comfortable with this. It's also interesting. I mean, in the UK, the FCA just approved an exchange called Archax to trade security tokens, and they also approved a custodial model for Archax. So I'd be interested to see if regulators domestically and internationally are communicating with each other on this, because I do think that there is a way to figure this out. And once the custody issue is solved on the security side, I think you will see institutions moving into this space pretty rapidly. This is a huge inhibitor right now.
Great. Thank you, Brian. One note to the audience: if you have any questions for the panel, just post them in the chat. Hopefully we'll save some time at the end to address them, or through some other forum. So Pei, shifting gears for a second over to decentralized finance, or DeFi, which is all the rage, what you hear about all the time, and has been attracting a lot of inflows purportedly of users and of capital. And some of these DeFi products allow users to, say, lend their crypto to a borrower or lock it up with a platform in exchange for some kind of interest rate or other return. But maybe just stepping back to what does DeFi mean, and what promises or risks does the DeFi sector hold, and what have U.S. regulators said about it, and what do we anticipate they will think about DeFi?
So DeFi also is known as decentralized finance, mainly refers to all the digital assets that we've seen in the space and financial services that are backed by smart contracts, which is like automated agreements across all parties, and also those decentralized applications we call dApps that are being built on blockchain network, especially in Ethereum. So I think the philosophy of the DeFi community, by and large, is to trying to create a financial system that is open to everyone and minimizes one's need to trust and rely on central authorities or intermediaries. So today, as you can tell, we rely on banks and law firms and CSDs and government do a lot of things. And And this is to try and promote the peer-to-peer type of social economy. And as you mentioned, Steve, DeFi, one of the most popular or common use cases has been borrowing and lending platforms. You can do a lot of things once you get on the Web3 and have some of cryptocurrencies or digital assets, and you can pledge them as your collateral. You can go around and borrowing in other currencies or in fiat, and then you go on and on. I don't know if you're following the DeFi space recently. There's a rage about sushi swap and following the Uniswap, and there's a ton of yield farming activities going on. So this is a very fascinating space that moves definitely light speed. But I think in addition to all those applications and interesting experiments around economies and business models, there are things like stable coins, and there's platforms like DEX, decentralized exchanges. They are also very instrumentally important for growing this ecosystem, because that's how you get on from fiat to digital cryptocurrencies, and that's how you trade with each other and funding prices and matching those trades and all of that. So it's overall very it's still very small sector if you compare the total value that's being locked up in DeFi contracts. That's below $10 billion. I know it's a large number, but compared to the traditional finance and capital markets, we're talking about in trillions measurements. So it's definitely a growing space. I think the regulators are still learning about DeFi. DeFi changes every day. They have a different face every day. So I will defer to Brian and Veronica to kind of opine on that as well. But in my seat, I look at it from a tech perspective, and I think finance has always been distributed on some level, because the nature of the business is that you have a lot of parties, a lot of people, a lot of risks get together, and they need to be managed in a distributed fashion. But the only thing with the current technology system is the underpinning finance infrastructure haven't been able to keep up and to support the distributed nature of the industry. So I think because of the popularity of Bitcoin, digital currency, and other payments innovations such as Venmo, people are coming to expect a lot more out of this space. At the same time, I think the enterprises are definitely looking for newer solutions that can enable this type of speed and transparency and P2P nature of doing businesses. There's a growing appetite for parties of a transaction to know exactly where things are and what the information is in a real-time manner. So I think I will continue, I think DeFi will continue to grow, and it will be interesting to see how the regulators come in and be part of that conversation, and how the enterprises continue to get involved. And right now, not so involved, but hopefully they will get involved and start building out their solutions one way or another, or just simply by kind of investing into that space. So this is sort of my version of explaining the DeFi space, and I'm curious to hear others' thoughts.
Well, first of all, any development that cuts reliance on law firms is not a good development. Okay, so let's not go in that direction.
I would expect that coming from a lawyer.
Yeah,
yes.
but
I'm
Brian,
outnumbered here.
Brian or Veronica, anything you'd like to say about DeFi and your respective markets?
Veronica, do you want to go first? I have thoughts as well, but I can defer to you.
Yeah, sure. So DeFi, the reason we're talking about this is because it is basically this is a new thing, and everyone's very excited about it, and there's a lot of potential there. But yeah, from my perspective as a lawyer, the question is regulation. How is it going to be regulated? I was literally just before this on a different webinar where this question came up, and it was, I'm thinking in terms of the U.S. And let's call it decentralized lending. We have the Truth in Lending Act, right? How are we going to comply with the Truth in Lending Act with a decentralized lending solution? Because one of the key features of decentralized anything is there's no one minding the store, as I said, right? So there's who do I regulate? If it's truly just a bit of software that was developed by someone and then sort of launched onto an Ethereum blockchain or something else, then the theory goes that and certainly in the wild and woolly world of crypto, the decentralized theory is there is nobody in charge. And if there's nobody in charge, who do you regulate? And who is responsible for delivering the disclosures under the Truth in Lending Act, or is anyone? Does TILA even apply? Like, how do we protect the consumer in situations for DeFi if there's no one to hold accountable for telling someone what their interest rate will be, or what any fees might be, or how to anything really, what the terms of a loan would be. Likewise, with staking, which is going to be more complicated for people to understand than straight up lending, but it is going to be, the challenge will be who to regulate and how to do so, because is it going to be, I assume if I was a regulator, I'd be looking for who's making money from this. It may be decentralized, but somewhere there's fees somewhere. This didn't grow organically out of the ground, and somewhere along the line, no one made a business case for it, so someone's making money somewhere. So is it, do the regulators go after whoever's making fees, but is it whoever developed it and is maintaining the system? It's going to be very interesting to watch roll out how this, because regulation abhors a vacuum, right? So and especially as regards consumer financial products, that's a very heavily regulated area, lending in particular. So I have a lot of thoughts on this, but I'll turn it back over to Brian for his SEC or his securities.
Yeah, so I agree with everything that's been said. I think DeFi is very neat. I think the potential is incredibly interesting. I think with a lot of things in blockchain and crypto, there are very legitimate projects in the DeFi space and not so legitimate projects in the DeFi space. And what I've seen over the last couple of weeks with sushi, and then yesterday I saw kimchi, there's all these different coins that are appearing, and I see memes and tweets about how this token or this protocol now has $400 million locked in its smart contract after only being issued 12 minutes ago. It's very clear what's happening with this right now is very similar to the ICO boom, where it may have legitimate underpinnings, but it's now being turned into degenerate gambling, I would say, and chasing after yield for a lot of people, not for everybody, obviously. There are some really great thoughts and projects in the space. To Veronica's point, I think what we said earlier would be kind of interesting here. The DeFi projects really, more so than anything else, to me, calls for some sort of centralized regulator, because you're looking at this space and you're like, okay, well, there are lending concerns. Are these commodities? Does the CFTC care about this? Does the SEC care about this? Does FinCEN care about this? Who are we regulating? You're just putting a smart contract out there. There's no centralized gatekeeper or party. And I think from a regulatory perspective, as Veronica pointed out, that's going to be a significant concern. But as we've seen, the regulators, technology tends to be about 6 months to a year ahead of regulation sometimes, which is understandable. So in that interim, I think we're going to continue to see a lot of interesting things come out of the DeFi space, hopefully mostly good. But there will be something that happens here eventually with the regulators, because there's just too much money changing hands and too much risk of fraud for there not to be, in my opinion.
Okay, great. Thank you all. So turning maybe away from DeFi, but into the maybe regulatory lag, as Brian just mentioned, about how innovators obviously outrun regulators in any industry, but particularly in the financial services industry. And there's obviously much work to be done. For example, and Veronica, I'm sure, knows this very well, to operate nationally a digital trading platform has to obtain money transmitter licenses and state to state in various different ways. And if you have a token, you have to make an assessment as to whether it's a security, applying a 70-year-old judicial test that has all kinds of hair on it and different circuits, and one judge said this, one said that, and you're trying to run a business based on these an antiquated or at least haphazard regulatory framework. So Brian, do you see the SEC making progress though in analyzing emerging technologies, and do you think the current framework can accommodate, say, digital asset securities, in a sense that can make them really ubiquitous within the financial markets? And if not, why not?
So I do. I think that the regulators are doing their damnedest to understand this. Specifically, the SEC, FinHub, and Trading and Markets have members and staff members who are very up to speed on how this works. I know that Securitize and others in the space have had great conversations with the SEC staff on this. From the securities perspective, I don't think that where we are right now is scalable. I think that, as we mentioned earlier, the biggest issue is custody. We've had great conversations with large institutions and banks, and this is the major hurdle. So if the hurdle can be overcome, like it seems they have, perhaps the FCA has in the UK, I see the industry growing significantly. I'm sure there will be other regulatory implications down the line as well. We are an SEC registered transfer agent. I mean, a lot of people sort of look at a transfer agent in the blockchain space and say, well, the blockchain itself is a record. Why do you need a transfer agent? Good arguments for that as well. So I think hopefully one day, the technology itself will be relied upon and trusted by regulators for certain actions that, registered entities are required to take now. I think we're a ways away from that, but I think in the long term, I think this technology provides great benefits to the capital markets from an efficiency perspective, a settlement perspective, and just a cost-saving perspective. So I do think that adoption will come, but from the regulatory side, we do need for sure to see more progress on the custody side, and I do think that will come sooner rather than later.
Okay, thanks, Brian. And Veronica, on the non-securities digital asset side?
Right. So, as you mentioned at the outset, and as I have mentioned, we have lots of regulators to deal with, sort of, juggling regulators. And once you think you've got an idea from this one, what about? Wait a minute, that can we comply with both of these at the same time? And if you're global, then you have to harmonize the record keeping requirements of GDPR with the travel rule, and all these various other things, and trying to harmonize it all becomes quite difficult, especially when you toss in 40 plus money transmitter regulators, and as Brian said, the SEC, or maybe he said Steve, but the SEC's the Howey test, but then it's not just the Howey test to find out if you have a security on your hands. It's the Howey test plus a couple of bits of guidance and maybe a couple of remarks from so and so. And this commissioner said something at his his sister-in-law's birthday party, and now we have to consider that. And you end up with 75 considerations to determine if what you've got is a security, and are you taking custody, or you're not taking custody, or your money transmitter, or you're not. And it's really all we want is some clarity to run a business, so that you know exactly what you're dealing with, and you don't have to do the educated guess or the detailed legal analysis for every single thing. And I'm a lawyer. I like doing detailed legal analysis, but it does get a little bit overwhelming sometimes when you're taking different jurisdictions. Plus, every jurisdiction has, how many regulators you have to consider. And in the U.S., that is a number of regulators, right? With FinCEN and the state regulators and OFAC and SEC, and so it's a as I'm fond of calling it, a patchwork minefield of regulation. And so what we're all looking for is some steady state framework that we can rely on for be great across jurisdictions, but I would settle for just in the U.S. one. And the OCC is attempting to do is making, not attempting to do that, but at least trying to make some headway there. But not everyone wants to be regulated by the OCC. So.
Hey, any areas where digital asset is looking at in terms that haven't been mentioned where greater regulatory or legal certainty will hopefully supercharge the industry?
I think the regulators have been doing a pretty decent job in learning and getting more clarity and policies out. I would say that in addition to clarity and maybe standardization and framework around custody, but also more clarity around how data should be monitored and reported. So the transparency of data, how just overall compliance should be conducted, right, across all parties that are involved in a digital platform. Would be good to get more clarity around those topics. And then how do you do a tax, for instance, that is preventing a lot of institutional investors, funny enough, to from participating in this economy in a more aggressive way. So.
Great. Well, thank you. So just getting near the end here, and wanted to ask y'all, each of you, we're more than 10 years out from when the first Bitcoin was mined. We've had roller coasters in value up and down from $1,000 to $20,000. The crypto winter, the SEC ICO basically shutting down the ICO market. You've got Libra and now digital dollars and developments along that. So what would you say, what is the state of FinTech generally, and what can we expect, in just really kind of a short answer each of you, in the next couple of years in terms of development in the particular markets where your companies are active? And I guess as an industry, what have the last couple of years of regulatory engagement taught us in terms of how to be successful in kind of moving the industry forward? So whoever wants to go first, go at it. Okay, I'm going to call on you. Brian,
Sure. So the overall state of FinTech, I have no idea, but I could tell you, one thing I think benefits FinTech companies in this industry when it comes to regulation is to try and proactively create a relationship with regulators. I think it's better to be proactive than reactive. I think that it's good to even just have informative and educational conversations with the regulators. I think that helps advance the industry because regulation, for better or for worse, does play such an important part in what we're doing here. On the security side, I'm optimistic. I think that blockchain, as I said before, and tokenization provides immense benefits for the capital markets. And I think when you pair that with things like the digital dollar or stable coins, I think it makes transacting a lot easier. Perhaps a lot more autonomous and individual, like Veronica mentioned. So I think the possibilities are really exciting. In the next couple of years, I think, if we get some sort of guidance on custody from the regulators here, which I think I've said like 10 times already now, sorry, I think that will help drive the industry. Or unfortunately, I think that a lot of the industry will move to jurisdictions, perhaps the UK or elsewhere, where they've made decisions on custody that work. So I hope that's not the case, because I think that the market here in the US is tremendous for this stuff. So we'll see. I'm optimistic on that happening, but that needs to happen.
Okay, Pei?
So I think in my view, we are all in this giant movement called digitization. And I do think, based on what has happened in the last 10 years and where I think we are headed in the next few years, I the distribution and digitization type of innovations are here to stay. I think we all forgot that we are in the middle of still a pandemic, which has actually been a major trigger to expedite the need for digitization, because you've realized as an individual and as a company that we've seen the vulnerabilities of all the manual processes and in-person needs for performing a lot of business functions that are existing everywhere. So I think after this pandemic, we'll see more and more digital innovations. And I think even more diversifications into their portfolios as an investor. And you've seen Paul Tudor Jones, and he tends to agree on this. So it's a really exciting moment. I think two things going to happen in the next few years. First, I would say we'll see more interoperability across systems and automations along the way. So this is one of the major focus areas for digital asset, and the work that we've been doing around the smart contracts and connecting different data ledger systems and stitch them together to make sure that they can communicate and interoperate regardless of which infrastructure they're choosing. And those are both blockchain infrastructure and traditional legacy infrastructure systems. So how can we figure out a way to bring the traditional and the new DeFi world together or closer using our technology and implementations is a big focus. Second thing I think will happen, and I hope will happen sooner, is not only that we would see the assets being issued in a very modern and digital fashion, either through a token or digital representation kind of way. I think what's going to follow after that is a surge of modern marketplaces where you as a company or individual can spin up your own marketplace where you issue assets and you create an exchange sort of, for the lack of better terms, an exchange or personal exchanges that where you can actually easily optimize and create in the community of people coming together and be able to exchange with each other on their assets through a very simple plug and play API integration, for instance. So I think it's the interoperability and connectivity across those systems, automating all the workflows and assuming the right compliance and regulatory implementation are in place, but also how people connect with each other and trade information or assets in a different way, in a more automated and digital way. That's another trend I see is coming in the near future. So definitely very encouraging and exciting time for everyone in this space.
Okay, and Veronica, to wrap us up.
So yeah, I agree with both Pei and Brian as to what's coming and what we've already seen, and I expect there to be right now this sort of innovation tends to just speed up, right? It gets sort of exponential growth, and from a regulatory standpoint, what I hope, I can't even say what I think will happen because I just can say what I hope will happen, which is that the regulators, that we have a chance to educate those who are in charge of building these frameworks and have a sort of a seat at the table and say, listen, let's talk about not what the rules are necessarily, but what the policy aims of AML or whatever your regulatory mandate is. Let's talk about what you're trying to accomplish. And we, as the people developing a technology and working in the space, can maybe help design a better way for you to achieve those goals than trying to cram new technology into existing regulatory frameworks that doesn't fit and ends up being quite cumbersome and create a lot of friction and a lot of headache where maybe there's a better way to do it. So that's kind of what I'm hoping for. I'm hoping that that the industry and the regulators and lawmakers can come up with a win-win.
Well, great. Thank you, Veronica, and thank you to our panel. I think it was, and hopefully you all agreed, was an informative session. Stay with us on the main stage for our final panel of the day, which will look at technology and ethics. Thank you.